This is Brian Carlton for ABN Newswire. I'm back at the Bowlers Club of New South Wales for the Symposium Resources Roadshow for September, where tonight's keynote speaker was the Chief Economist at Herston Economics, Clifford Bennett. Now, Clifford's rapidly gaining a reputation for being somewhat of a Nostradamus of the market forecasters, minus the long beard. Picking the bottom of the market in March, he tipped a light GFC impact for Australia, got the unemployment numbers about right, and a bunch of other things I hope to talk to him about now. Clifford Bennett, welcome to ABN Newswire.
Thank you, Brian.
Now, you're tipping borders on economic heresy sometimes, but you seem to nail it. What's influencing your forecasts that others aren't getting?
Well, I think, Brian, there's a lot of factors involved, but I like to call what I do look out the window economics. And it's all very well to have your textbooks of how economics worked over the last 2 to 3 decades, but it's very important to understand what's happening in the world now, how it's changing, how economies function differently. Competitive price pressures, if you like, now, for instance, are real. People do compete on price, whereas in the 60s and 70s, people didn't compete on price. So there are real changes from how economics functioned in our society to how it functions now.
So these changes are both micro and macro?
Very much on the macro. I think the micro is probably aspirations, if you like. Human aspiration is more out of the bottle now than it was back then as well. And that's particularly the case in China. One of the reasons I'm so bullish China is because of the human process that's going on there and not just sort of looking at economic numbers.
Let's have a look at the Aussie dollar, racing towards parity with a declining US dollar. You're tipping it to exceed parity, and not just by a little bit, by a good margin.
Yes.
I think $1.12-ish
yes.
by 2012.
Well, yeah, the $1.12 will be an overshoot for sure, but markets do overshoot. I think we're definitely going to see 103 rather quickly, 108, probably in 12 months' time, and the 112 very likely to follow that. What we have to understand is the Australian dollar is having a long-term historical price shift to a higher range based on an entirely different regional economic environment that didn't exist before, and it's against a declining US dollar. So you have two different processes happening at one time. One is falling US dollar, one is appreciating Australian dollar. So of course, Australian dollar to US dollar is a big price shift.
What about some of the arguments that your fellow forecasters are putting that the Aussie dollar is already overvalued, and kind of realising that currency investors will profit take at the top end, near parity, and keep it just under? You don't buy that?
Well, look, the Australian dollar could in fact on its first run fall just short again and back off, but if it even touches parity, it won't spend much time there. It will just fly higher significantly straight away. But when people talk about the Australian dollar is already overvalued, I'm saying, or I said a few years ago when people argued the US dollar is at the bottom of a 20-year range, therefore it's got to bounce back. I said it's at the bottom of the 20-year range of the last 20 years. The next 20 years ahead, it's at the top of the range. People have to understand the Australian dollar was once $1.49, Brian.
Yeah.
And then it fell to 48 cents. I called it the dollar that lost a dollar. We're bouncing back to the midpoint of the range, and we're going to overshoot. But it's a very different world now. People respond to recency, frequency, and intensity. So I can understand that most economists out there, certainly their experience is that this is the highest they've ever seen the currency. But the world has changed, and the currency is going a lot higher.
I want to talk to you about how the world's changing in a second, but what impact will such a high Aussie dollar have on the Australian economy?
Sure. It's a good thing in a very important way, and that is that it gives the Reserve Bank of Australia room to not raise rates, because it will have a deflationary impact on consumer goods here. Otherwise, we would be set for a very strong period of inflation. I think GDP is going to be incredibly strong. But inflation will be controlled because of higher Australian dollar and because of competitive price pressures. I think the outlook's very good across the line there.
So, while you mentioned rate, let's talk about that. You're claiming GDP will hit about 6.5%,
sure,
but inflation only running at about half that. Your argument is that the Reserve Bank's only just kind of getting its collective head around the idea that you can have such strong growth and relatively low inflation.
Yes. Let's be fair. The Reserve Bank hasn't exactly impressed of late with some of its intellectual thought. I mean, it made a big mistake, I think, when it told markets that it wanted to have monetary policy at the average of the last 10 or 20 years. I mean, if the full intellectual weight of our Reserve Bank and the hundreds of people that work there is that they average the past, what is the point? An HSC graduate can do that. The Reserve Bank has to be able to go out there and intellectually discover new ground in economic thought, in how the world is really behaving behaving at the moment, and one of the big ways the world has changed is competitive price pressures. It doesn't matter whether you're a corner store or a global corporation, you can't raise prices without losing market share. Why has there been such high productivity growth over the last 10 to 15 years around the world? Because it's the only way to maintain profit margin. You know, once upon a time, boards of directors in the morning would go into the office, say, how much does the widget cost to make, add the profit we want, that's the price that goes to market. Then they would go to the golf club. Boards of directors don't get to go to the golf club in the afternoon now, perhaps once a month.
Other times are changing.
Because it's hard work now. You've got to roll your sleeves up. What price will the market bear? How do we get our costs down so we still make a good profit? The only way to do it is productivity.
So your argument is that if the Reserve Bank takes a kind of knee-jerk approach here, and as soon as that growth figure gets at the top end of their target range, they whack rates up, blunt instrument, we all understand that, that would be a mistake in your view?
Yeah. You know, I went off a little bit on a tangent there, but basically what I was saying is that even with high input prices, high commodity prices, the price of goods to the consumer will stay low, right? So inflation will stay low despite strong growth. And the Reserve Bank, if it can come to grips with that, will understand that we're in a period of low interest rates. I mean, look at China. China, it's a different economy, yes, but it's a very sophisticated economy in many ways as well. It's now running at 10.7% growth. Inflation is akin to ours, pretty much the same as Australia, 10%, and interest rates, official interest rates, they're at 2.25%. That's an extreme example, but going forward, Australian Reserve Central Bank has to understand we can have tremendous growth, low inflation and low interest rate environment.
When are you tipping the Reserve Bank to pick up on this advice and move their top end target up?
You know, they're aware there's a two-speed economy. I was very encouraged by their last statement, which said that they expect inflation to be just above 3% over the next couple of quarters due to the tobacco impact. So they're starting to see through just the aggregate numbers, which they have to do because, you know, another very important point is raising interest rates in Australia does not slow the economy of China. So how does raising interest rates in Australia slow down our export sector? It doesn't. It only hurts the domestic sector. So they've got to just completely forget the aggregate numbers for Australia, set the export sector aside, focus on the domestic sector. The domestic sector has firmed up. It's doing well now. Why? Because they didn't change rates for the last several months. We had a period of stability in interest rates in this country. The domestic economy has come on strong. Growth is good. The Reserve Bank doesn't have to hit it on the head now by starting to raise rates again. So I'm very much arguing for them to stay on hold till the middle of next year.
Let's talk US for a sec. You're leaning towards a slow recovery in the USA?
Yeah, it's a slow and steady recovery. It's already in place. It's better than what people would have us believe at the moment. The US economy is going to have, and in no way do I mean this with disrespect to the people who don't have their jobs, but the US economy is going to have a period of firm growth, strong profit and revenue streams and growth without unemployment coming down. You basically are going to see US unemployment stay at 9.5%, perhaps for 2 to 3 years, while at the same time their GDP is close to trend, and at the same time their corporate earnings are doing very well.
So you're arguing that the rest of the world will largely drag America out of its economic mire. What's the mechanism there? How's that going to happen?
I wrote a paper a few years ago called Big C Saves Little C, China Saves Capitalism. You know, China is the most entrepreneurial country on earth now, not the US. Eurozone is the biggest economy, not the US, but there are issues for the Americans to get their minds around. But certainly the rest of the world has rescued the US economy. The US economy lags the rest of the world. It once led, now it lags.
So this is a fundamental decoupling, if you like, of the global economy from the United States economy.
That's that a lot of people have used, but you know, and it's already occurred. It's not a theory. You know, Asia and Latin America, the growth of trade between those countries, a phrase I coined, which was intra-regional growth, where these countries discover that they can trade with each other and perhaps make even more profit on the same goods trading with each other than they used to by shipping it to the US. So there's this huge upswing in energy in regions around the world. And we're now starting to see these regions start to do more and more business with each other, which is, you know, Asia's doing more business directly with South America now and vice versa, as opposed to it all being focused on the US. So the mature economies of the world, the Western economies of the world, Europe and the US, they're going to do better than most people expect at the moment, but nothing spectacular. Whereas Asia, Latin America, even Eastern Europe still coming online are going to do far better than most people expect.
Let's have a look at gold. You've tipped gold to continue to rise based on its popularity in China and India, amongst other things. How much will it go up? Can you put a figure on it? Is it possible?
So, you know, some people have come out with big numbers like 3,000, 5,000. We've got to remember where gold's come from. It's come from $270 an ounce. You know, we're now at a very good, nice number up in the, you know, hitting 1,300. I'm looking for 1,450. That's still another 10%. Then 1,650. It's about another 30% rise in the value of gold. That's a big move considering how far we've come already.
So
and it's icing on the cake for the industry.
I was going to say, you'd be arguing that the Australian gold producers and explorers are on a good thing here?
Definitely. I mean, you know, some of these people were making a profit when gold was at $270 an ounce, $350 an ounce. It's now at 1,300. It's probably going to go 1,450, 1,650. My long-term forecast, if you like, Brian, from there is perhaps 2 to 3 years consolidation after 1,650, but staying very high. Then we're going to see much higher levels going further out.
You're particularly bullish. Is there a warning sign? Is there something that we need to look out for to cause this to collapse?
Well, the only thing that could go wrong on a global level is a major conflict. And prosperity tends to weaken the desire for conflict. So I think basically the prosperity of the world's going to be seeing it's never seen before. And I know that sounds like a cliche phrase, but it's actually true. And I think we're going to have less and less conflict, but that is the only risk to the global economy. The only risk to the Australian economy, I don't think we're going to have a mining tax. I think any carbon tax is going to be after the rest of the world comes to agreement. So I don't see those as real risks. The only real risk or threat to the Australian economy is if the Reserve Bank goes into its old school way of thinking with a blinkered vision and keeps hiking rates just because growth rates are strong. It has to not do that.
So what should they be forecasting or what should they be suggesting as the top end of their growth range before they would act on rates?
They shouldn't be targeting growth. They shouldn't be thinking what's the highest number, because we're going to have numbers we've never seen before. We're going to have numbers like my 6.5% forecast, which I'm concerned is a conservative forecast.
Wow.
Okay, that's really my concern. We're going to have numbers we haven't seen before, we're not used to, but if they can focus on the inflation data and lead indicators on inflation rather than lead indicators on growth, we could be in for a really golden period in Australia.
Clifford Bennett, Chief Economist of Herston Economics, thanks so much for joining me today.
Thanks very much, Brian.
This is Brian Carlton for ABN Newswire.